Disclaimer. What is trading? Let me ask you something simple. What if the way you think about trading matters more than any strategy you'll ever learn? Not the charts, not the indicators, not even the market you choose. Just the way you approach decisions when money is on the line. That idea might sound subtle now, but keep it in mind. As we move through this video, you'll see why everything else builds from this mindset. Welcome to MOOLAH IQ. In this video, you're going to learn what trading actually is, clearly, calmly, and without hype. Plus, for those new to trading, we'll present some simple steps you can take right away to build a solid foundation. You'll understand what trading really means in practical terms. How is it different from investing? The main ways people trade. And most importantly, the one habit that quietly separates thoughtful traders from frustrated ones. We'll return to that habit in a moment. First, let's clearly define what trading means. At its core, trading is simple. Trading involves buying and selling assets to capture price movement. You buy at one price. You sell at another. The difference, after costs, is either a profit or a loss. That's it. But here's where many people get confused. Trading is not about predicting the future. It's not about being right all the time. And it's not about constant action. Trading is about decision-making under uncertainty. Have you ever made a financial decision quickly, then wished you had slowed down just a little? That moment is where trading actually lives. To drive this point home, let's pause for a moment and compare trading to investing. Investing typically involves committing money to assets with the primary goal of growing wealth steadily over a long time, often years or decades, by relying on the asset's appreciation, interest, or dividends. Investors usually think in terms of long periods, focusing on sustained growth across years or decades. You care about businesses, earnings, and growth. Time works for you. In contrast, trading involves more frequent buying and selling of financial instruments, often within days, weeks, or months, to profit from short-term price movements. The emphasis is on timing and capturing changes rather than holding for the long term. Traders focus on price movements and potential gains from shorter timeframes. Time can work against you if you're careless. Decisions matter more than predictions. Neither approach is better. They solve different problems. Many people successfully do both, but only after they understand the difference. Let's make this difference tangible. Before clarity, I'm trading, but I'm hoping. After clarity, I know why I'm in this position and why I'll exit. That difference is everything. Trading exists across many markets: stocks, indexes, futures, options, currencies, commodities. The market itself matters less than people think. What matters more is liquidity, volatility, and your ability to manage risk. Have you ever switched strategies or markets hoping the next one would finally work? Often the issue isn't the market. It's the lack of a repeatable process. For instance, adopting a simple rule such as always set a stop loss before entering a trade can make your approach more consistent and disciplined. Next, let's address an important truth that's easy to overlook. Trading isn't about winning every trade. It's about managing risk over time. The goal is to manage risk well enough that probabilities can play out over time. Professional traders don't think in single outcomes. They think in sequences. One trade means very little. 100 disciplined trades mean everything. Are you judging your progress based on single wins or consistent behavior? That answer matters more than most strategies. Now, let's look at the most common trading styles and what makes each unique. Day trading, positions opened and closed on the same day, requires structure, rules, and emotional control. Swing trading, trades held for days or weeks, focused on short-term trends. Position trading, trades held for weeks or months, sits between trading and investing. Each style demands something different from you. There is no best style. The most effective style is the one aligned with your temperament, schedule, and discipline. Start by evaluating your daily routine and emotional responses to trading wins and losses. Decide whether you prefer structure or flexibility, and consider the time you can devote to monitoring trades. Staying aware of your emotional stability during market changes will help you confidently match your trading, your approach to your needs. Before, Choosing a style based on excitement. After. Choosing a style based on sustainability. Now, let's discuss the part most people overlook. Risk. Risk. Every trade answers one silent question. How much am I willing to lose if I'm wrong? Good traders decide that before entering a trade. Struggling traders decide after emotions show up. Two traders take the same trade. One sets risk up front, the other does not. Same chart. Very different outcome. Risk management doesn't make trading exciting, but it makes it survivable. Pause here, because what comes next matters more than any tactic discussed so far. If you understand this, trading becomes clearer. If you miss it, trading always feels stressful. Here's the habit we opened earlier. The most important habit in trading is decision consistency, not intelligence, not speed, not confidence. Consistency. That means entering trades for the same reasons, managing risk the same way. Exiting without negotiation. Markets reward discipline over excitement. Before versus after. Contrast. Before, reacting to every market move. After, responding only when rules are met. That shift changes everything. Trading brings emotions to the surface, quickly. Fear, impatience, overconfidence. These emotions aren't problems. They're signals. The goal isn't to eliminate emotion, it's to avoid letting emotion drive decisions. Relatable question. Have you ever broken a rule you knew was there for a reason? Awareness comes before improvement. Take a short pause. Ask yourself, why does achieving your financial goal matter to you personally, beyond money? Stability? Freedom? Peace of mind? Knowing this helps you trade less but better. Trading rewards preparation, not urgency. Like any skill, it improves with repetition. It requires feedback and it punishes inconsistency. Progress often looks boring from the outside. And that's a good thing. Short example, the traders who are last aren't the loudest. They're the most methodical. If you're new, start here for clarity. Learn how markets move. 1. Focus on risk before profit. A good starting rule: risk no more than 1% of your account per trade. This minimizes losses and protects your capital while you learn. 2. Trade smaller than you think you should. 3. Review decisions, not just results. This framework builds confidence without pressure. As we finish, one final pause. Ask yourself, what is the first small step you can take today to improve your decision-making? One rule, one habit, one adjustment. Write it down if you can. If this video helped you think more clearly about trading and decision-making, please take a moment to like, comment, and subscribe to the channel. It helps this channel reach people who value calm, clarity-first finance. Leave a comment sharing one insight or action you're taking after watching. And subscribe to MOOLAH IQ if you want thoughtful, hype-free guidance on money, investing, and trading. Remember, money grows faster with clarity than with excitement. You don't need more trades, more tips, or more opinions. You need better decisions, repeated consistently. If today's video helped you think more clearly, take one small action before you move on, because knowledge without action doesn't compound. This is MOOLAH IQ, helping you increase your financial IQ one wise decision at a time.